Your unique story, our global audience. Global One Media.
Hello, and welcome again to another one of our equity analysis episodes, where we look under the hood and examine the performance of different companies with Chris Thompson, the Director of Research at eResearch, which provides analysis services and supports investors in their decision-making process. I am Munir Barazi, your business analyst and host, and the company we will discuss today is DATA Communications Management. Chris and his team have written previously about this company, and now eResearch has released a new update. Hello, Chris. Good to see you again.
Hi, Munir. Thanks for having me.
So you've recently written an update report on the Data Communications Management, or DCM. What were the key highlights in this new report?
Yeah, DCM had two announcements recently. One was that they made an acquisition, and two was that they put out preliminary Q4 results, which were quite positive. So they made an acquisition announcement of the Canadian operations of Donnelley Sons. And so it's going to substantially increase their revenue, almost doubling their revenue once the acquisition closes. So that was quite positive. And then they also made an announcement that their Q1 revenue was slightly higher than it was the previous year, and it was higher than our estimate. So again, that was quite positive for the company.
Those are all positive developments, but I want to focus a bit more on this acquisition deal. Tell us more about this deal and its potential impact on DCM.
Yeah, so Donnelley is a large multinational company that had operations in US and Canada. And so what it's doing, it was acquired a couple of years ago by a private equity firm, and they're actually spinning out the Canadian operations. DCM purchased them, or the plan is to purchase them for about $123 million. And the company has, according to what was released, has $250 million of sales. So that's a pretty good acquisition multiple. You know, it's a half times almost revenue half time acquisition to the actual revenue, which is good. And they're going to fund it all by debt, so they're not doing any dilution of doing equity shares into the market. As I mentioned, Donnelley, the Canadian operation, has about $250 million of revenue per year and 10 locations across Canada, 1,000 employees. So it's similar in size to DCM, and we think there's going to be a lot of synergies when the two companies come together, with locations, with operations, with sales, etc. So this will immediately sort of catapult DCM into a $500 million revenue company, which really sort of changes the metrics on the company.
And could you tell us a bit more about those synergies between the two companies?
Yeah, so for people who've been following DCM, they've been doing some their own synergies, consolidating operations over the past couple of years to become more profitable and to improve margins. So this type of acquisition is a really good fit for them, because they can just continue on with this rationalizations. We think that the combined companies will have some definite financial benefits, through the synergies of the sales staff, the different locations, improving the operational efficiencies. I think from a customer standpoint, it makes them that much stronger, building bigger relationships with their customers. It'll allow them to cross-sell more services with their customers. The operating models definitely have some synergies. They operate sort of in the same way. And with, now $500 million of sales, you do have that economies of scales where you have a larger group, providing services, and that should help reduce the costs and improve the operating margins, which are important for generating cash flow. For those who follow the company, DCM does have this digital first strategy where they're trying to get more services, and so definitely having a larger customer base will help out. And so I just think overall, when you're looking at this type of transactions, it does immediately have a doubling of revenue, which is a great revenue growth for the company. It adds a couple of hundred more clients to their existing client base. I think that will take DCM from about 280 clients to more than 400 clients include the overlap. And I think you get a whole new talent pool with the Donnelley Canada team coming in, so you can sort of pick the best and brightest to help you move things forward. And I just think a lot of these synergies will help drive cash to the bottom line, which will improve the EBITDA and cash flow of the combined company.
Sounds like a recipe for success. And DCM recently pre-announced its Q4 results for 2022. How did it compare with your model?
Yeah, so we had about, for 2022, we had revenue coming in a little more than $265 million. DCM guided that it's going to be closer to 270 to 274. Gross margins were relatively the same in the 30.5% range. And same thing with their SG&A, which is coming in around mid 21.5%, which is again in line with what they had. Adjusted EBITDA, which is what we look for, the cash flow portion is around the same we have in our model, which is $35.5 million, which should be good. And their cash, their debt level seems to be a little bit better than our model. So what we're going to do is we're not going to update the model yet. The financials are coming out during the week of March 20th. And so once those financials will be out, we'll update the model in itself. But overall, we think it's positive for the company.
And those two events are major events when it comes to DCM. How did this affect eResearch's valuation?
Yeah, so we did two different scenarios for the company itself. First of all, we updated the model with the improved Q4 numbers, and that did increase our target price slightly, which was good and positive. And then for the transaction itself, we put the new metrics into our model. We had to make some assumptions on gross margins. We don't think that the gross margins of our Donnelley are as good as DCM, but we'll have to wait until the final numbers come out on that as well. But definitely, it did increase our target price by about $1.50. When you combine the two together, it increased our target price by about 50%. For investors, I encourage them to go onto the website to download it, the actual report. It's a 10-page update report. It's a smaller one this time, just covering off these two events, and they can see how we calculated it and the changes in the model. From a comparative standpoint, even with after the announcement, DCM did go up in price a bit, but even so, it's still trading at only 0.6 times revenue, EV to revenue, and 5 times EV to EBITDA. So I think that those are metrics. When you look at the space for other companies which are in the printer comps, definitely it's lower than the averages. And if you're looking at how they're trying to move more and more of their sales towards the higher end, digital access management, or the tech-enabled workflow, which are have multiples sort of in the 2 to 4 range. Definitely, this company is trading sort of below at the metrics. And so we still think our investment thesis holds strong. And this is one of these companies which is undervalued. And this acquisition, I believe, will help fund and accelerate the growth of the company over the next year to 2 years as they implement and consolidate and improve efficiencies.
Terrific performance. Thank you, Chris, for your insights and time.